Imagine being able to build an app with your name on it, just by thinking about it. Meet Base 44, a complete AI creation platform. Describe what you want, and watch it take shape. You can plan, customize, and expand in any direction. From tools.
The job market, again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's again highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick.
Nick Tamarosa of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts. And they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So you put that in there too. So those are the two ways that the two things I think that drive these things. Remember, though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things, and I think as the data come in, you should see those differences diminish.
If I could follow, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Mr. McKee.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
Look, from my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again,
okay, if there's one AI site builder you need to meet, it's this dope tech from Wix. Now, this whole flow is a conversation.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids picking up significantly, what kind of effect would that have on the labor market in
Sorry,
the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration.
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of, how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Kelly.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well, the forecast for inflation in December was 2.5%. Core PCE for 2025, the forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be, we've learned that the tariffs are going to be substantially larger than forecasters generally thought. And, we don't, our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming and that would mean higher inflation. That's what happened. And so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans, small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis, that, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now. And inflation is, 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs, because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind, or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years though talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking at, I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So, again, we think that our current stance of monetary policy is in a good place.
Amira.
Thank you. Amara Mokwe with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no. And I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we do. We work hard. But I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public. We're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk.
Lori has a wide range of programs as well as minors and options for students. I feel career ready because all the theories I'm learning in the classroom have really been taught to me and applied to real world situations.
Are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're going to hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Claire.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous. And so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate. But it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks, worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see, layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
Victoria.
Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But but that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Yeah.
Thank you. Chair Powell, Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation, and what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points, because, AI should be creating jobs at the same time. It may be replacing, may be doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. You know, they say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. That, you know, of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, you know, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Greg.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. You know, there's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, you know, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people, like, some sort of, like, explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to like change how the dollar, movements of the dollar was impacting the economy. Are we going through something like that now? That, you know, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. You know, from a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. I mean, but and it doesn't change our objectives or what we need to do. And you know, these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. You know, will it be, there have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. You know, AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know, though. So both housing services and non-housing services have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit. And of course, we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effective tariffs through to the next person in the chain, and ultimately to the consumer. Today, you know, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
Because there are tired dogs in your area, there are drivers in your area. Uber.
We generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, you know, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjust it over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term as you get out to the later years. It's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over by
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. It's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about, cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5–2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very slow continued cooling, but nothing that's troubling at this time. But we watch it very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's again highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at normal, resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things, and I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it?
Imagine being able to build anything just by thinking about it. Meet Base 44, a complete AI creation platform made for anyone with an idea and a drive.
Backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months. And we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Mr. McKee.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
Look, from my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids increasing, picking up significantly, what kind of effect would that have on the labor market?
Sorry,
in the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration?
Yeah.
I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could If you could elaborate on the potential changes to the SCP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SCP is part of it. Many other ideas. It's sort of how do we think our communications can be improved? There are a number of ideas. People offered a really it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are
positive, but it wasn't enough for the whole segment to pull through.
What are they doing, or what are they saying about tariffs and the impact on their costs versus maybe what they're trying to pass along to customers?
So they are offsetting some of the costs with cost savings. It's usually going to be, they expect it to be about 1 to 2% of COGS this year, which is a little bit lower than, for example, Campbell's expected. They expect around 4%. So, they do not want to raise prices. They want to be competitive because obviously volume growth is not happening. So.
Yeah, I mean, they're getting competition from more folks. I mean, on the one hand, they're benefiting from the fact that more people are eating at home, right? But yet, when we're going to the supermarket, more people are choosing those private label brands.
Correct.
So did they talk about that at all on the earnings call, and what's their sort of plan of attack there?
Yeah, so they're increasing marketing. They're hoping for innovation. They mentioned that 25% of sales growth will come in North America retail, will probably come from innovation this year. And this is what everybody's trying to get to. The problem is, and that was mentioned on the call as well, was that even the price increases are not as significant as it used to be, they're still high. So on a basket size, you're still paying a lot more than you used to 2 years ago.
Talk to us about store brands versus kind of the brands we all grew up with here. Talk to us how that's changed over time. Are store brands becoming a bigger part of the average cart?
Yes. Well, retailers are investing more on their private label. It allows them to bring people into the store. Some of the brands have a cult following, I would say. Hello, Costco.
Mm-hmm. Yep.
So
exactly.
So people are going to the store to buy that particular brand. They're more profitable than national brands. So obviously there's still incentive for retailers to deploy some of their own brands.
I think some people think it's chic to buy private label, right?
Well,
sort
I don't know.
Wear it like a badge of honor.
Well, it's certainly. I was shocked at the price differential.
Yeah, because they have that pricing power, right? These stores is to make their products a lot more attractive. Really quick, Blue Buffalo, it's their pet food. I was surprised to see that was not a leader for them.
Yeah, so Wilderness is not doing as well as they are hoping. Dog food in general has been a headwind, not only for them but also for the overall industry. Cat food seems to be the leading indicator here, which is surprising. But
So cat food is outpacing dog food?
yes, correct. We have seen this for the past year.
What in God's name is going on?
John Tucker had to chime in on that.
It's
talk about dog food and cat food.
Well, there seems to be a growth in the cat population more than the dog population.
Wow, interesting. What have we had a good retail sales number yesterday, better than expected. Are your companies, the consumer products companies, what are they saying about the consumer?
Yeah, like I said, they're looking for value. They're still seeing their budget as a whole rather than the price increase or decrease. They're looking for price cuts wherever they can, and they're willing to trade down for it.
All right, so for General Mills, one of the things I liked about your company's nice fat dividend yields, 3-4%. General Mills is like 1 and change. What's the policy?
Yeah, so they're investing in the business. They're trying to be a little bit more assertive on the innovation side. So that is affecting shareholder returns.
I mean, let's be honest. This is GDP at best business, probably less than GDP growth.
Yeah.
You got to give us a 3-5% dividend yield. I don't know. That's just my thoughts there. Deanna, thank you so much. We appreciate it. Deanna Rosero Peña, consumer staples analyst, Bloomberg Intelligence. One of the good ones out there covering these consumers.
You like saying her name. I know you do.
I love saying her name. Yeah, exactly. Since day one, I'm all over. Get the correct pronunciation. Some other people say, Deanna Rosero Peña. Come on.
Put a little something into it.
Exactly, exactly.
I'm with you.
All right, looking at these markets here, as John Tucker darkens the door here, we kind of have mixed here. So we'll stay on top of it here for you. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour, Bloomberg Intelligence, starting in moments. Again, looking at the bond market here, let's call that out. The two-year Treasury is up a couple of basis points here ahead of the Fed at 2 p.m. 3.52 on the short end of the curve. 10 years pretty much flat here at 4.03%. We had another IPO coming out today, StubHub. I'm going to see if that thing's open for trading. I'm checking on Belly Lipschultz. He supposedly covers the equity markets and IPOs. So we'll see if he's got anything for us. He's coming up. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, Alexis Christophers, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So head over to that YouTube thing. That'd be the intro web for John Tucker. And just ask for Bloomberg Live Radio, and that's where you find us. All right, coming up in this hour, a lot of stuff going on here. Highlighted right at the top of this hour, a couple of minutes, we're going to have the StubHub CEO, Eric Baker, who's speaking with Bloomberg tech anchors Ed Ludlow and Caroline Hyde on the IPO of that company. We're also going to bring you some comments from Bank of America Chairman and CEO Brian Moynihan. He was on Bloomberg Surveillance this morning. We'll bring some of those comments as well. It's Fed Day, which means I only have one request. Danielle DiMartino Booth, CEO and Chief Strategist for QI Research.
Order
She'll
filled.
be with us to kind of preview all that stuff. And Kevin Tynan, he's the Director of Research at the Presidio Group. We'll get the latest news on what's happening in the auto business. He is our go-to guy on the auto business. So a lot coming up in this hour. Let's kick it off with Mr. John Tucker and a Bloomberg Business Flash.
And welcome back. Major stock averages that mixed ahead of the Fed decision this afternoon. You have 8 of the 11 major industry categories in the S&P 500. They are higher right now. Consumer staples, that's in the lead. Information technology, worst performing industry group. You have shares of Workday, ticker symbol WDAY, best performing individual stock in the S&P 500. It was up over 8%. Elliott Investment Management, the activist, disclosing a stake in the human relations software company. Uber, worst performer in the index right now. It was down close to 5%. Meantime, Jeffrey Cleveland, the chief economist at Payden and Regal, says the labor market, the big concern for the Fed at this point.
The balance of risks have shifted since the last FOMC meeting towards labor market weakness, and solid is not the right word to describe the labor market at this stage.
Order filled.
NVIDIA falling just about 2%. You had a report from the FT, but China's internet regulator had banned the country's biggest tech companies from buying its AI chips. And here's one for you. North American airports seeing a boost in traveler satisfaction. This is according to J.D. Power. You want to guess who's number one? I say that with a question mark in my voice. Minneapolis St. Paul International Airport, ranking first for the second consecutive year. This is in the mega airport category. And they say improved food retail offerings and smoother airport navigation are important factors. And I know when I think food, I go to the airport. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. How was your trip?
Trip to Italy was fantastic. People were great. So much history, just everywhere you turn. But I tell you, it was crowded.
No kidding. Even
oh my goodness!
Wow.
You'd think high season would be over, but no.
No, their high season. We were told their summer high season is now shifted. It used to be July, August. Now it's more September, October. They noticed it starting in the last several years. I mean, if you got the kids, you go in the summer. But people who don't have kids, they just come to September and October because it's just too hot for them.
You ate really well.
Great.
Okay.
Great. Might have had a.
Well, we got to get back to
bottle of wine
business,
or two.
I think, right? I could talk Italy all day.
Yes, exactly.
Bailey Lipschultz is in our Bloomberg studios here in New York, senior equities reporter, and you've got your eye on some market drivers today. Workday, I guess, is on your radar?
Yeah, JT mentioned it, starting with Workday, ticker WDAY right now. Shares are up more than 8% this coming on a bit of news, kind of a burst of news. So not only did they have a strong analyst day that drew at least 2 upgrades from sell-side analysts, Elliott Investment Management came out saying they're one of the largest shareholders in the company, really applauding that they've made progress, talking up the advancement and enhancement of the company's operating model and capital allocation framework. Board also authorized the repurchase of up to an additional $4 billion of stock. Analysts basically saying that the forecast that they called out, signaling strong profitability. There is still that elephant in the room, AI, how that impacts sales and subscriptions, which seem to be slowing, but nonetheless, a big move higher for Workday, still down about 8% so far this year.
When I get my car share, I arbitrage. I go open up my Lyft, open up my Uber, and whatever gives me the best price. Since it's the same driver in the same car, usually in most cases, Matt Miller does not do that. He just goes straight to Uber.
He does it because of the credit card points for some reason. I think it's lame.
That would be the implication, but I'm not even sure you just made it that far. Boy, they're having a good day today. What's going on?
Yeah, seeing a big move in shares of Lyft, ticker LYFT, after the company's name, up more than 12%. This coming after unveiling plans with Waymo, the Alphabet-owned driverless car technology company, to unveil and offer robo-taxi service in Nashville starting next year. Big fan of Nashville. I don't know if you've been. This will start through the Waymo app early next year and ultimately spread to the Lyft app. So the next time you're down listening to some country music, you can hop in a
Nashville is the bachelorette party capital of the world.
Is it really?
Yes. It's like surpassing Vegas. I don't know how they do it.
They call it Nash Vegas these days. I was just there for Labor Day.
Okay.
But they call it Nash Vegas.
All right.
But that's sending also shares of Uber, ticker UBER, down more than 5%.
I tell you, the stock for Lyft is up 75% year to date. So maybe the market's saying, okay, maybe this driverless car partnering strategy is a good one.
And this is a company that's still trading now at the highest level since 2022, but really pales in comparison to the return for Uber. And I want to cap off with NVIDIA quickly. Stock down almost 3%, one of the big drags in the S&P 500 today. This coming, whether it's a sell the news event or being pointed to the FT reporting that the China's internet regulator has advised companies, including ByteDance and Alibaba, to terminate their testing and orders of the RTX Pro 6000D. So that's one of their chips. So NVIDIA down about 2.75% right now, ticker NVDA, one of the big drags in the S&P 500.
And in just a few minutes, we're going to have StubHub CEO Eric Baker. He's going to speak with Bloomberg tech anchors Ed Ludlow and Caroline Hyde. And would love to get your thoughts, though, Bailey, on StubHub going public today. We're still waiting for
Order
it to
filled.
begin trading. I guess it tried to go public a few times, right? All right, so finally here we are. But the valuation, I think half of what it had thought it might be valued at when it was first thinking about going public.
Yeah, this is a deal that raised $800 million. And we had been hearing from people familiar, even just a few weeks ago, that they thought this would be north of $1 billion and that their valuation could be closer to that $13-14 billion bogey as opposed to about $8.6 billion at that IPO price. But this has been a slog for the company. Obviously, we saw one of the busiest weeks in quite some time last week with Klarna and others going public. But StubHub, when I talk to investors, it's a different beast. And that was a big part of this conversation. And my colleague just putting out right now that they tightly allocated this deal to top investors. You've been trying to position this company and set it up to succeed. But again, where it priced versus where investors might have thought it would price, different dynamics than we saw with some of the hotter IPOs last week and even going back into the summer like a Figma and some others.
So we've had it. I mean, it seems like the last, certainly since in Labor Day, this IPO market's picking up. I know you don't, that's not your remit these days, the IPO market, your broader equities, but how's the calendar look for the remainder of the year? Are we going to continue to be busy for the next month or so?
It's interesting, Paul. So last week was the busiest, I'll call it the busiest based on size. We kind of have some ESPN type stats for that, but busiest week since 2021. We have a pretty busy week this week with StubHub today, Netscope will price tonight and trade tomorrow. That's a cybersecurity company. But it kind of falls off. I was meeting with an advisor this morning who was basically saying it kind of looks like a rocket ship, and then right now we're dealing with that return to gravity. Calendar is at play, but nonetheless, when you are seeing some of these deals printing, it should be interesting to see post-Fed what companies flip and what the calendar stacks up like for October, which should be a pretty big window.
I mean, having been in this game for many years, the IPO game, the new issuance game, I got a lot of things in my back. I got markets at or near all-time highs. I've had a bunch of deals that have priced well and traded well.
VIX is at 16.
VIX is at 16. I mean, if you can't get a deal out today, kids, what are you waiting for? It seems like I'm surprised we haven't seen more, but I've been saying that for a while here. Anyway, the ones that are coming out into the marketplace are trading well. So what that typically does is stoke more demand from the buy side for more stuff.
But we have seen kind of a mixed performance, and I do want to call out Gemini Space Station, the Winklevoss twins company. It broke issue today. It's down 9%. So for every, figure, they're a blockchain HELOC company. For every company that's up, 50, 60%, we have a few that are either a breaking issue or close to that IPO price. So a bit mixed.
Yep, very good. All right, Bailey Lipschultz, always the best equities reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. Looking at Stub, priced at 23.5. Indication rates here, pre-market 25, bid 26 on the offer side. So we look like we're getting closer to getting a market opening here, and that'll be a good thing. Coming up right now, StubHub CEO Eric Baker speaking with Bloomberg Tech Anchors host Ed Ludlow and Caroline Hyde on the company's IPO today and future growth plans. So we'll have to see how the play is for this live event business. I'm going to a live event tomorrow night. So SeatGeek, StubHub, Live Nation. I mean, they're all there in the game. It's a competitive business, but boy, that's where the growth is in the musical business, is in live events. So right now, let's go to StubHub CEO Eric Baker alongside Bloomberg's anchors Ed Ludlow and Caroline Hyde speaking about the IPO for StubHub, ticker STUB. Let's listen in right now.
That values the company at around $8.6 billion. The ticket reseller is the latest company to go public in a US IPO market, experienced a bit of a hot streak. Let's speak with StubHub CEO Eric Baker, who joins us now from the NYSE. Eric, the history. You set up this company in the year 2000, sold it to eBay, bought it back, amalgamated with a European giant you had already built, and now it goes public. How does it feel?
It's tremendous. A lot of gratitude to reach this milestone for the company. It's certainly been a long journey, as you say, from 2000, but now we're really focused on the next 25 years and the bright future ahead.
Take us to the next 25 years, because there are regulatory headwinds. There are people worrying about bots. There are a way in which you can beef up this business to add more things in secondary market ticket sales. Where do you go? Where do you focus?
Yeah, so our focus really is we've always wanted to make it easier for people to access live events. And so what we started with is, as you noted many years ago, was to make the resale market safe and secure and easy for people to access tickets. What we're focused on now is we realize consumers don't care whether it's a primary ticket or a secondary ticket. They just want to access the live events that they want to go to and discover easily, safely, and so forth. And that system's been pretty broken for a long time, how those tickets are originally distributed. So we're really working on creating a better experience, and we've already had exciting partners like the Yankees and Major League Baseball who have started selling tickets directly in this open distribution network.
You looked at going public in a time where Taylor Swift had gone through the Eras Tour. There was a lot of hype and momentum, and you hit pause. You're doing it now, and I think a big question everyone's got for you, Eric, whether they're a consumer or not, is what happens next with a regulatory crackdown. The practices of your industry are very much under the microscope at the moment.
Well, I think, first of all, we're always excited to be at the intersection of technology and live events because we're very bullish on the future of live events, and we think that doesn't change. To your question about regulatory focus, I think two of the things really people have looked at, one was transparency and pricing. That we at StubHub have always advocated for. And that all-in pricing that we lobbied for passed at the federal level in May. And that's just a better experience for consumers. And the key is it's now a level playing field for everyone in the market. I think the second real regulatory focus, quite frankly, has been what the Justice Department is looking at with the primary issuance of tickets and making sure that networks are open and fan-friendly. And that is something we certainly applaud because we're on the side of the fan.
Eric, is artificial intelligence a headwind or a tailwind for the secondary ticketing market?
Yeah, we see it as a tremendous opportunity, a tremendous tailwind. And I think if you think about it, again, we're a technology and product company. And I think Alex Karp at Palantir, I don't want to miss a tribute, put it really well that he said the artificial intelligence technology for companies that have tremendous data allows you to provide a better product while increasing your revenue tremendously and reducing costs so that everyone wins. And we're seeing that across the board, how we deal with customer service, how we're releasing new features in the product to make it easier for people to locate the tickets they want. So we're very excited about it. And again, with the leadership position we have and the scaled proprietary data we have, we think the sky's the limit.
We are speaking with Eric Baker, founder, CEO of StubHub, to our radio and TV audiences. You say AI could help drive revenue tremendously. Let's talk about your revenue thus far, because in the first half of the year is about 3% growth. That is significantly slower than the previous. Now, we know that maybe we haven't had Taylor Swift on tour this year, but Eric, are you seeing a slowdown in demand?
Yeah, so thank you. No, we're really seeing people continuing to buy tickets and growth. I think it's important to note two of the things that happened that are unique this year. One is Taylor Swift, and her tour is behind us, and there is only one Taylor Swift. So I think she's so tremendous, we even broke her out in the S1, so it's great to be that popular. Second is, as I mentioned, all-in pricing passed in May, and when we lobbied for it, we knew that creates a one-time hit to the market as consumers just adjust. We've seen that already in states like New York that had passed it before. So when you look through those headwinds, the business is growing extremely nicely, north of 20%.
I'm interested, though, on your profitability or lack thereof, Eric, because it's interesting you've gone public without that story to tell. When will it become the story you can tell?
Yeah, no, I think what you're referring to is by the accounting metrics like net income, that it shows a loss. But I think when we went on the roadshow and when investors look, they really look at EBITDA, which is your earnings before interest, tax, depreciation, amortization, as well as your cash flow. And on that dimension, we've been profitable for a long time and generating hundreds of millions of dollars. That's the way we've been able to service the debt that we've had. And obviously now that we're deleveraging and taking the debt down, our cash flow will even go up further. So I think that's one of the many reasons that our story was very well received when we went out on the roadshow and by our new partners.
Eric, Bloomberg did some deep reporting on the FTC looking at Ticketmaster, Arrival, on the issue of bots hoovering up tickets for resale and their inaction. Have you discussed that issue with the regulator, and how are you addressing the problem?
Yes, we've always, and bots, and it's interesting as you note, is really about how these tickets are distributed in the first place. And so one of the things we've always lobbied for is enforcement of the Bots Act. And that's really because we believe that these tickets need to be distributed in a way that's safe, secure, democratic, through open channels. As you mentioned, they're looking at, I believe, Ticketmaster and others who are handling the primary issuance of the tickets. And they really need to make sure that their technology and safeguards are in place to make sure this doesn't happen. But again, it's something that we're very pro-consumer. That's how we win. So we hope that all that stuff gets cleaned up.
Eric, very quickly, next year's soccer or football World Cup, how big an opportunity is that for StubHub?
Look, we love the World Cup. It's been a phenomenal event because think about it. We run the largest global platform in the world for ticket exchange for all kinds of events. And if you had to say what is the largest global event in the world, I think you can honestly say it's the World Cup. It's people from all over the world traveling to come see events. It's going to be in North America. It's extremely exciting. And we're excited to hopefully help as many fans as possible make their dreams come true to access getting to the World Cup. So we're all football fans, so to speak, in 2026.
We're football fans here too. Eric Baker, founder and CEO of StubHub Holdings. Great to have you on the program. Thank you. Now, coming up.
All right, that was StubHub CEO Eric Baker speaking with Bloomberg Tech anchors, hosts Ed Ludlow and Caroline Hyde. StubHub went public today. 23.5 was the IPO price, kind of in the middle of the range. It's indicating right now 25.5, 26.5. I've passed this prologue here. These things tend to open up around 11:30, 12 o'clock for trading, so we'll see how that works out there. Bank of America Chairman and CEO Brian Moynihan, he was on Bloomberg Surveillance this morning. He sat down with Bloomberg's Jonathan Ferro and Lisa Abramowitz to discuss his expectations out of today's Fed decision and his view on the U.S. economic outlook. Take a listen.
The tension the Fed has to deal with, and you've been picking at it all day, is the tension between a higher inflation rate and ultimately where Fed funds could settle in at. And so whether they do 25 basis points today or 50, people have to keep in mind, the growth rate in the economy was brought down, and now it's starting to go back up. So next year is predicted to be better than this year, and the year after is better than that. So you hear our teammates talk about the economy growing back out. And that then means we're on the other side of it. And so the Fed has to adjust to the inflation picture as it got more in control. They can come down. They came down 100 basis points already. It can keep coming down, but they've got to be very mindful of the inflation side. And so I think when the people get in the room and they see the data, they have to think it through. The big news since that you referenced earlier was the labor market's gotten softer, so that gave them concern. So I think the market believes and our teammates believe they'll cut rates. But I think the key for people is deceleration of growth, and will the growth reaccelerate? You hear our teammates seeing that. We're seeing consumer spending strong and all those things, which would indicate we'd see the acceleration. Next year's better than this year. Unemployment is not expected to go up a lot, even though the employment picture may be softer. But the most important thing is the long-term interest rate scenario people projecting is a more normal rate environment that we saw before the financial crisis. Say 3% plus or minus on the Fed's fund rate, 4 to 4.5% or so on the 10-year rate, and a curve that's not inverted, that's normalized between that. The important thing is to get back to more of a normal environment, frankly, with maybe a little higher inflation, because the great debate about 2% is something you can get lots of experts talk about. A little higher inflation, a little faster growth, and then, frankly, that'll help with some of the debt carry and other things going on in the U.S. economy.
All right, that was Bank of America Chairman and CEO Brian Moynihan. He was on Bloomberg Surveillance this morning. Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowitz, they were down at the trading floor this morning for their broadcast, for their show this morning in Midtown Manhattan, so they were able to speak with a lot of the leaders of Bank of America, and Mr. Moynihan speaking via Zoom from London. He's there for President Trump's visit in London, so we got that as well this morning. All right, let's get a little bit of a reset here, and for that, we can check in with John Tucker for Bloomberg Business Flash.
All right, the major averages right now, they are mixed to a little change. The Dow up 311 points. A lot of that has to do with American Express, Walmart, Caterpillar, the big gainers, the Dow right now. S&P 500, little change, down 3 points right now, 66.03. And then you have the NASDAQ 100 down 90 points. Of course, all this could change after 2 Wall Street time when we get the Fed rate decision. By the way, this report brought to you by Oracle. Attention growing businesses, Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers. with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. And again, waiting for trading of StubHub, the ticker symbol STUB, as Paul mentioned, priced at $23.50. NVIDIA, they have the biggest weighting in the S&P 500, and it's weighing on the index. It's down close to 3% right now. And then you have shares of Lyft, on the other hand, up over 12%. They're partnering with Waymo for the first time to offer robo-taxi service in Nashville starting next year. Again, 2 p.m. Wall Street time. We'll learn the Fed interest rate decision. Betting is we're going to see just a quarter of a point rate reduction in their benchmark. Weight loss drug developers gaining after Eli Lilly said its experimental oral diabetes medication, which I'm not even going to try to pronounce, worked better than Novo Nordisk drug in a head-to-head study. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alexis.
Thanks very much, John. About 11:22 on Wall Street, and we want to check in with what's happening over in London, across the pond, because the UK is giving President Trump and First Lady Melania a royal welcome in their second state visit. They got a carriage ride at Windsor Castle, dinner shortly with King Charles III. Let's get the skinny on all of it with Anne-Marie Horton, host of Bloomberg Surveillance TV. She is there in London. I guess you're in Windsor right now. I'm looking at you here on our feed, and I see the flags of both countries behind you. Lots of pageantry. Sort of paint the picture for us. What's happening right now?
Yeah, a tremendous amount of pageantry here, an unprecedented second visit for President Donald Trump. He said leaving the White House that he was at Buckingham Palace the first time around. He said this destination, Windsor Castle, he's told is the ultimate destination. As you mentioned, there's been a carriage ride. They did lay a wreath as well next to the tomb, on the tomb of late Queen Elizabeth in the chapel inside the walls of Windsor. And right now we are waiting to see is what the Ministry of Defense, United Kingdom, is calling an unprecedented military display of force and ceremonial welcome for anyone that's been invited to the United Kingdom. And that's when we're going to see stealth jets from the United States and the UK, so F-35s and Red Arrows, join in this exercise over the skies between London and Windsor. So we're waiting for that to happen. And then this evening, there's going to be a state banquet. And that's when it's going to get very interesting, especially for our viewers, because we are going to see the President of the United States flanked by the top tech executives, which all announced tens of billions of dollars into the United Kingdom when it comes to quantum computing, cloud investing, and critically, AI, as well as other notable leaders in the finance and business sector like Larry Fink. So that's going to take place this evening. So today is really all about the royal pageantry. And then tomorrow the president will sit down with Prime Minister Keir Starmer, who's in a very different position politically today than he was back in February when he brought the invitation from King Charles to the president for this unprecedented state visit.
Anne-Marie, we know the Windsor Castle is actually outside of the center of London. I know in the center of London there have been some protests regarding this visit. What can you tell us about kind of what's happening for some of the folks that may not be as welcoming for this president?
Yeah, there have been protests, as there were in 2019. I don't know if you remember, in 2019, there was the baby blimp flying around London of President Donald Trump. This time around, actually last night in Windsor, you had a group of protesters project onto the walls of this 11th century castle a photo, an image of Donald Trump and the late sex offender Jeffrey Epstein. And then also as well, there was a massive banner that was rolled out in the city of Windsor, a picture of those two men, tennis court size. So that's the protest side. But we should note there actually have been supporters as well, lining up the streets of Windsor. Individuals walking around with Make America Great Again hats. I spoke to one individual here to support President Trump. He said he also was in Washington for the inauguration. He was wearing a hat that said Trump was right about everything. So it's a bit of a mixed bag of individuals who are supportive of this unprecedented state visit. But certainly yesterday on display here in Windsor was those protesters displaying the image of Jeffrey Epstein and Donald Trump, which also is political right now, a hot topic in the United Kingdom, because after revelations of the close relationship between Lord Peter Mandelson and Jeffrey Epstein that Bloomberg News reported about and revealed in these emails, you had the third ouster from Keir Starmer's government in 14 days. And that was, of course, the British ambassador to the United States.
And Anne-Marie, what else do you think we can expect from President Trump's meeting with the Prime Minister in terms of real substance outside of these big tech deals that we know have already been announced?
Well, the big tech deals have been announced, but I think one thing the president might want to discuss, especially given he is getting urged by dozens of Republicans on Capitol Hill, is to really push the UK to drop the digital services tax. And the president may use the fact that you have companies like Microsoft spending $30 billion in the United Kingdom as a reason to bring that up at the table. Leaving the White House, the president also said potentially they could refine, those were his words, refine the trade agreement. We do know that the UK wanted to discuss bringing down the steel tariff, which right now is set at 25% to zero. They also wanted an exemption on Scottish whiskey. It looks like the United Kingdom is not going to be pushing for that, but the president did say there could potentially be some refinement. So trade is certainly going to be discussed. We definitely know tech and digital service tax is likely going to be discussed. And then I think big geopolitical issues regarding what's going on in the Middle East, what's going on with the war in Ukraine. These are all issues that likely will be discussed when the two leaders meet tomorrow. And that will be at the Prime Minister's country estate in Chequers.
Very good. Anne-Marie, thank you very much for your reporting. Really appreciate it. Very helpful to us. Anne-Marie Hordorn, co-anchor of Bloomberg Surveillance Television. She is in Windsor, England, in the UK, covering President Trump's state visit to the UK. We appreciate her reporting today. It is Fed Day, of course. Give you the kind of the lineup here. 1:30 p.m. Tom Keene and the surveillance team will join you. We'll be simulcasting radio and television with the Fed Day. And then at 2 o'clock, we get the statement from the Fed. And then at 2:30, Fed Chairman Jay Powell will hold his press conference. Bloomberg's Michael McKee is in Washington, D.C. He'll attend that press conference. So we got you fully covered on the Fed here today. And whenever it's really, I appreciate getting opportunity to speak with our next guest, Danielle DiMartino Booth. She's the CEO and Chief Strategist for QI Research here. Danielle, I know you followed this closely with your time at the Dallas Fed. What do you think the Fed should do today, given all the data we've seen over the past several weeks? What do you think they should do?
Well, so I think it's more than just the 911,000 downward revision to the annual benchmark numbers that we saw through the end of March, the 31st of 2025. It really is the downward momentum since then that we've seen. Had the Fed had those real-time revisions in hand, then they would have seen that there was justification for lowering rates in May, June, and July, right? We now know that we've had 3 months of construction job losses, et cetera, because it's more so right now the real-time revisions that really, the pandemic notwithstanding, June's job losses were the first since September of 2010.
Right.
So first time in 15 years. These are kind of like bright red flags. Yeah. So it's pretty obvious that the easing cycle should have begun early this summer. And so that's why there's so much in the way of rumblings about will there be a triple descent today between Myron being there for the first time, Bowman and Waller. You know, by the same token, you got the St. Louis, Kansas City duet. Will we see Alberto Musalem? Will we see Jeffrey Schmid? Will we see them dissent in favor of no cut?
Really?
Well, I mean, the more hawkish and uncertain you are about eventual and ultimate pass-through of tariffs into consumer prices, the more hawkish you're going to be. And one can only imagine at a higher level how very awkward and uncomfortable it is around that gigantic wooden oval table today in the Eccles building.
Yeah, talk about awkward meetings, right? This is going to be one of the strangest I think we've seen in quite some time. But Daniela, I just want to jump off what you're talking about in terms of cracks in the job market, because a number that I think is a pretty good current number to look at is unemployment claims, right? And they're the highest they've been in a long time. But at the same time, you know, inflation at 2.9% is moving further away from the Fed's 2% target. So, you know, what's the Fed to do when stagflation is on the horizon?
You know, and that's a great question, but I'm not so sure that it's stagflation necessarily for the consumer because of what we saw in terms of margin squeeze that was very apparent in the producer price index, and the fact that whether it's Walmart or Target, they're telling us we're having to discount furniture. We're having to discount discretionary goods. We cannot get our customers to buy discretionary goods. Bloomberg did a great job of covering Moody's, showing that now 50% of all consumption in the United States is attributable to the top 10%. That other 90%, they cannot afford higher prices because they're already forking out so much for what we call essentials.
All right, so let's assume we get maybe 25 basis points today from this Fed. What do you think the cadence might be over the coming meetings?
So if we are to see, as Goolsbee warned, Goolsbee, of course, does not vote until January when he rotates in. If we were to see continued upward momentum in claims, if we were to see that line crossed of 2 million in continuing claims, which separates itself from initial because that means that people have been approved to become continuing jobless claimants. If we're to see a continuation, 87% of Texas home builders, 76% of Florida home builders are laying off right now. We saw those single family.
Even the great market of Dallas-Fort Worth?
Oh, it's incredible to see how construction has come to a screeching halt. Even in Dallas. And we're overbuilt, and a lot of what I call the Airbnb jocks, they can't get financing. Right now, refinancing is really hard, but banks are clamping down on their lending standards. Look what happened with Tricolor last week. So banks are really paranoid about the state of consumer balance sheets. So to the extent that you bought a handful of apartments in during the pandemic, thinking that you'd get rising weekly Airbnb rates, VRBO rates on your property, that isn't happening anymore, and that's going to be highly problematic. On top of the fact that baby boomers are also getting nervous, and they've got gigantic homes that millennials don't have enough children to fill. So housing could be a thorn in the Fed side, and including in inflation for some time to be.
We get these lower rates. We know that one rate cut's not going to move the needle. Two, maybe even three if they're quarter-point cuts. But if we're going to be in an environment of lower interest rates, isn't that going to help the housing market?
In theory, it will. My gosh, we saw a 57% jump in refinancing applications because of the decline. And in fact, we saw almost $100,000 increase week over week in the amount of money people are trying to pull out of their homes. The amount of refunds. So people are obviously desperate to monetize what's in their home. We only saw a 2.8% bump in purchase applications. So affordability for people trying to break into the housing market is still prohibitively high. That 25 basis points isn't really going to move the needle. But again, I think you may have enough dissent today that we're going to be talking very quickly about a 50 basis point rate cut at the October meeting.
So do we rule that out for today, 50 today, do you think?
Jerome Hayden Powell, Esquire, is not a man to surprise the markets. And by the way, just total trivia, it is up to the Federal Open Market Committee in its entirety to elect the chair of the Federal Open Market Committee, which is a separate position. You could theoretically have President Trump replace Powell come May, which he will do, and still have Powell at the podium every Fed day until January of 2028. It's entirely legal and possible.
That would be fun. All right, Danielle, thanks so much for joining us. Danielle DiMartino Booth, CEO and Chief Strategist for QI Research, joining us live here in our Bloomberg Interactive Broker Studio on Fed Day. We always make an effort to get on Danielle's calendar to get her thoughts on this Fed here. The market's kind of treading water a little bit here. The S&P is pretty much unched on the day. We got a Dow moving higher. Some of the big financial stocks, Goldman Sachs and so there's American Express moving higher. That's up 300 points. The NASDAQ off 115 points. So not a lot of direction out there. The Tom Keene VIX sitting right at 16 and change. 10-year Treasury yield, 4.03%. Pretty steady right there. Mortgage rates, I can get close to 6% now. It's getting a little bit better. This is Bloomberg.